StatsCan says the economy added 8,200 jobs in November. Not that many, driving the unemployment rate up to 6.8%. In the U.S., hiring slowed in December as employers added an estimated 50,000 jobs. Let's get more from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much indeed for joining us. Start off with the Canadian job numbers. What was interesting there?
Yeah, what was interesting is that is what I call puzzlingly positive. You know, we continue to get good job numbers out of Canada, which from our team's perspective, we're still looking into in regards to what are the true drivers, because our view is that Canada will underperform the U.S. And there's so much uncertainty. It's not an environment where you typically see job creation, but we are seeing it, especially on the full time. And we're surmising that the reason is the U.S. is doing very well growth-wise, continues to do very well growth-wise, and this is some of the side effects of that.
The Canadian job numbers, when you look at job numbers, monthly job numbers, Earl, do you tend to group them to, I mean, obviously there's swings in any given month. Do you look more at a 6-month average, or how do you handle these numbers?
Yeah, so we look at the trend. So what's that trend? Is your 6-month average higher than your 3-month average? What is it from month to month? So we definitely do that to try to smooth it out. And the trend is definitely positive from a jobs perspective, which is good from the economy, which is good for people being able to spend, people being able to pay their mortgages. So that's strong. And it kind of falls into our view that Canada will muddle along from a growth perspective, still have positive growth, but not quite as positive as the U.S.
There was an expansion of the labor force, more than 80,000 in December. Is there any particular reason why that would have happened? I know it's just 1 month.
Yeah, no, you know what? I think it's just people, in regards to hiring, we do know there's hiring in the restaurant industry per se. They've been understaffed. I think it's just a comfort level in regards to hiring. We're past at least peak tariff uncertainty. Yes, we have Kuzma to deal with this year, but at least from a retail and restaurant perspective, we feel that people are more comfortable going into the market looking for those type of jobs and looking for jobs in general. So that's positive. That's why the unemployment rate increased to 6.8, but it was due to participation. So that's a good reason for the increase as opposed to lower jobs.
Turn to the U.S. market, if you would. The U.S. employment numbers. Traders seem convinced that there won't be an interest rate cut from the Fed this month.
Yeah, we fall in that camp as well. One of the things, you know, the news, lower employment or, you know, having less jobs than expected is usually positive for cuts. But what we also saw was higher wages. You know, they were expecting 3.6% increase in wages. We got 3.8. So that kind of speaks to the underlying inflationary tone. So we think feeling employment will keep the Fed on neutral, but growth will keep it on neutral as well, too, for now at least.
And America essentially has easy credit conditions, though. It's easy for companies to borrow, for example.
Yeah, what I would say is two things. One is obviously their interest rates are lower than they were last year, so it's cheaper for companies to borrow. And by the end of this year, they will have what we will call easier credit conditions. And the reason why I say by the end of this year, what's expected in the U.S. this year is removal of some of the bank regulations around capital. So what that does is it gives banks more money to lend, and then there's a multiplier effect on the economy from that. So they will have easier credit conditions by the end of the year, but they definitely have a lower cost of credit right now.
Maybe we could put up a 5-year chart for TLT, the big ETF that's a proxy for the U.S. bond market. In general, would you be a buyer of U.S. long-term bonds right now, Earl?
No, I'm not as positive on TLT because it's 20-year bonds is underlying, and I'm not as positive on 30-year bonds. I am positive 10-year bonds and 5-year bonds. So right now we have a slight underweight, but we're coming very close to levels where we start buying bonds. And the distinction is once you get out into that 30-year, 20-year factor, there's so many other things that could impact the level of those rates, which are inflation impacts everything, but most importantly, fiscal. What's your deficit spending and what's going on there? And also the increased geopolitical uncertainty brings a bid or buyers of your shorter term bonds, 5 to 10 years, because there's increased uncertainty in 20 to 30 years. So you want to get more yield there. So we're not a big buyer of TLT or a big positive TLT or 30-year bonds, but we are positive 10-year bonds and earlier maturities.
You have a bond suggestion for us, for those investors who like buying corporate bonds, and it's an issue by MDA Space.
Yeah, they're actually the makers of the Canada Arm. If you remember the Canada Arms from a year back and say, so they're the makers of the Canada Arm. And so they're in the defense, military defense area. They're an approved bidder for RFPs for U.S. Shield RFPs that go out there, and they're a big client of the Canadian government through Telestat. So we like their revenues, $1 billion a year. We like that they have a backlog, $4 billion plus backlog. Their interest coverage, so their ability to pay the interest on the bond's good, and their yield is exceptional. It's 6.4%, which is 150 basis points over your Canada bond. So we really like that. They are high yield. And the reason why they're high yield is it's a capital intensive business. And they have concentrated clients, the governments. And we know how it could go in the U.S. It's a bit more fickle than it would be in Canada. But the overall trend of higher defense spending, we think is very supportive. And that's a company we like very much.
Right. I see the S&P rating is BB-, which would be sub-investment grade.
Yeah, high yield, as they refer to it. It's not the lowest of high yield. High yield could go to CCC. Yeah. So it's right in the mid. It's basically the better high yield company, if I could say that. And it's a company we're very comfortable holding. One thing I would put out there from an individual investor perspective, you don't want to hold this alone. You want it in a portfolio of bonds because obviously there's always default risk, and you don't want one bond driving your overall return. So you want it in a broader portfolio of bonds, but it is an attractive bond in a portfolio.
Now, this may not be on your radar, but can you remind me, has BMO issued an ETF that tracks high yield bonds? Or I know our market is so much smaller domestically.
Yeah, you know what? I think BMO has one of the largest suites of ETFs, definitely here in Canada, fixed income ETFs. So we have everything from shorter corporates to longer high yield and everything in between, so to speak. Like our active core fixed income mandate is one of those ETFs, is that CPB. But yeah, very broad array of fixed income ETFs. So you could do whatever you'd like to do in ETFs, basically, through the BMOs.
Thank you very much. Yeah, that one. I think you refer. You have CBO as well, which is the Oh, sorry, that's an iShares product. But yeah, you guys, and you have the biggest. I think you have the single biggest bond fund in Canada, ZAG.
Yes, ZAG, which covers the FTSE universe. Right. So we have the passive, which is ZAG, and then the one I mentioned, ZCPB, is the active, based on the same underlying universe. So we go into high yield, we go into tips, a little bit of global bonds as well too.
Thank you very much, Earl. Really appreciate it.
You're welcome.
Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management.